Perfect. So absolutely delighted to be able to talk to you about this piece of work, which is both theoretically informed, but also excitingly for us, we wanted to write it because it's such an important issue. We wanted to write it in such a way that policymakers and practitioners could understand it. My co-author, Konstantinos Chalkias, is here with us as well. So I'm going to talk about the book. He's going to answer all the hard questions. But also, just to say that we were fortunate and we went to get a grant from the European Union specifically so that we could make this book open access, because we wanted to be able to make it possible that people can understand the way key institutions that we take for granted may be breaking down, and the consequences of that are increased poverty, inequity, and a range of other things. So feel free to distribute this book at the end of this talk if you found it at all interesting, but let me talk you through what we found, because I'm sure that most of you will have thought, oh, a talk on insurance, even with the word disaster in front of it, for a Monday morning, that's going to be heavy going. Hopefully I can persuade you at the end of this that we should be looking at insurance, and it's way more interesting than you thought. I'd like to start by just talking to you about the New Zealand earthquake, which I think that you may or may not be aware, but New Zealand is one of the most disaster prone and also, well, risk exposed and also insured countries in the world. So you may think to yourself, well, that makes sense. If you're very risk exposed, you should be very insured. Yeah, that makes good sense. But actually, usually that's not the case. The more risk you are exposed to, increasingly, the less that you are insured. And I'm going to talk to you a little bit about why that is and why that is a problem. But on the good side of things, in New Zealand, it was very insured. And in 2010, 2011, they had a series of catastrophic earthquakes that killed 185 people, and it basically changed Christchurch forever. So in that sense, there was liquefaction, which means the soil never comes back. There were over 8,000 houses that need to be removed. The cathedral broke down, and they have never been able to rebuild that city. So it gives you some idea that this is the magnitude. Imagine one of your cities, something like that happening to them. This was a terrible thing to happen, and nothing makes it good. But there was one at least small good thing, which is that 90% of New Zealand homeowners were insured for earthquake. And as a result, there was some money to help them to rebuild. So, but the questions really for the global insurance industry was, this is a very tiny country. These earthquakes were unexpected and actually were considered to rewrite the model. So what we think we know about these risks, when they are insured, and they go catastrophically wrong and you get major disasters, it rewrites the model. People learn more about it. And at that time, they were like, how could we get such a massive loss from such a small place? But on the good side of things, as I said, 90% of people were insured. And the reason that they were insured is that in the 1940s, the New Zealand Earthquake Commission was set up. This was done because the Parliament, the MPs, realised that people who wanted to get insurance, already the private sector did not want to offer, even without great models back in the 1940s, the private sector understood that this is a very shaky place and we can't afford to offer insurance here because we don't know what losses we're going to have. Under the circumstances, they believed, the MPs believed that their job was to make it possible for people who wanted to insure themselves to do so. And so they set up what we call a protection gap entity, which I'm going to explain to you, which is the New Zealand Earthquake Commission, now called the Tokatu Ake Earthquake Commission. And how it worked at that time was it was compulsory. So if you have insurance in New Zealand, you have earthquake insurance, and it comes, the first piece of it comes through this government-based scheme where the first 100,000 of any loss that you have, the government will make good. So they take a little piece of the premium, and then anything over and above that, you can buy more if you want to. The idea around that amount was that that means everybody's got something to make them better, and that would be sufficient. They've actually increased that amount now, but it meant that everybody gets something in order that we can get these houses rebuilt, and it's compulsory. So everybody has to be part of it because we need to collect premiums, and we need to make sure that all people are protected from this thing that could happen. And as a result of that, This was a $40 billion total loss. I mean, this is a very tiny country. Okay, so this is a lot of money in any country. This is a lot of money in this country in particular. And what was really great about this is the Earthquake Commission already paid the first $10 billion of that loss based on the fact of this way they'd set up this scheme. Because they had set up this scheme, the private insurance market, which had not wanted to insure New Zealand, had been willing to, because they get to sit, like the first 100,000, which is most loss normally happens in that lower level, would be taken by the government scheme, and they would only have to take catastrophic loss, which indeed is what they did end up taking. But as you can see, in a $40 billion loss, $31 billion were paid from public and private insurance, which means only $9 billion needed to be on the public purse. And this is a really important thing for us to understand, because the public purse is just us, right? We are the public purse. So in that sense, it allowed global capital to flow into New Zealand to make people, to help people to recover from a disaster. That is what insurance does. So if you're sitting there and thinking, wow, insurance, boring stuff, actually insurance, how global capital comes into local economies to make people better after disaster. And that's a really important thing. However, and this is the thing we want to draw your attention to, and why I'm grateful to talk to people working in this sustainability space, you don't need to be an insurance nerd like me or like Konstantinos to realise that the global insurance sector is really in dire straits. So I haven't put anything up about the LA fires. Quite frankly, the reason I haven't is because while we all noticed the LA fires because famous people lost their homes, in fact, California has been pretty much uninsurable for fire since 2018. So what happened in California, we already knew was coming because it has experienced wildfire after wildfire repeatedly, to the extent where private sector insurance for wildfire is almost not available. And indeed, the thing that they do have there is this kind of thing, a bit like what we're going to talk about today, as the only way to keep those insurable. So all of these kinds of things, you look around in these different countries, and what you see is the insurance sector is no longer able to cover the places where disasters happen. So should we care about that? Because they're just a private market, aren't they? And like, why should we care about markets? So what, does that mean they're losing some revenue, Paula? Is that what you're telling me? I don't care whether they're losing some revenue. Yeah, you should care. And this is why you should care, because it's not about their revenue. It's about the fact that insurance brings global capital into local economies after disaster. What we see is that in countries with high insurance can even get a spike in their GDP after disaster, because money comes flowing in to rebuild and, in fact, to replace old with new. So in that sense, insurance is an important way that our ecosystem has learnt to respond to and recover from disasters in productive ways. On the other hand, countries that do not have insurance get set back decades. I mean, some of these small island economies, for example, can lose 200% of their GDP in one single hurricane. So, you know, you're thinking about this, well, insurance does start to seem maybe a little bit more important than making money for a market. The problem is that in advanced economies, disaster insurance is in retreat. The higher that the disasters happen, the more losses that they have to pay, the more that they put the prices up, and therefore the less people are insured because it becomes too expensive. In the country I now live in, 15% of households are face what is called extreme insurance affordability stress. I actually want to use this measure because when people say to me, well, you know, what's unaffordable insurance? I mean, you know, like Jonathan, because he is a professor here at King's, perhaps £30,000 is nothing for him, but maybe some of you who are doctoral students here at King's, so you say, well, what's unaffordable? So this is an actuarial measure that is valuable because it's 4 weeks or more of pre-tax income to buy an insurance policy. So now that makes good sense, because if you think for a minute about how much money comes into my household in a year, okay, so 4 weeks or more of that pre-tax, given that I will buy my insurance policy after tax, could I afford that? And I'm a professor and I couldn't afford that. So just to sort of say, let us put this in the situation of this is not people being profligate, not people not being willing to pay to cover themselves. This is people simply not being able to afford to pay to cover themselves. And that is a problem because we assume that they can. and that therefore we don't have to worry about them after the disaster because, well, some money will come to make them good, won't it? They'll be fine. You know, be a bit nice in the first week or two afterwards, and then I'll forget about them because the market will work. So we're going to be called on to do a great deal more. But, just to give you a bit of an idea, and I butchered this statistic really just to show you that if you think that's a problem in developing economies, look at the kind of challenge we face in emerging economies in terms of how very little penetration they have to help them to make good after disaster. So just to give you some feel for this thing, what I now want to do is I want to explain to you empirically why the insurance market no longer works, but then I want to explain it to you theoretically using paradox theory. And the reason I want to do it in these two ways is empirically you will be able to find this stuff in the news. But when you see it as an empirical thing, you think, well, is there not just some simple lever and you just do this and this and you'll fix this empirical problem? That's why I want to explain it to you theoretically, and that's why we should have centres like the Sustainability Centre here, because we need, theoretically, you will understand, we can't just pull a few levers. The system is irretrievably changed and we need to create a new system. And that's what theory can help us understand. So let me explain to you how insurance works, because some of you may have chosen not to find out about this, and I can fully understand why that would be. So basically, you know that you're exposed to some sort of loss. So you buy a policy, and mostly so Konstantinos buys a policy for flood, and he just pays a premium to his insurer, and mostly the kinds of floods that you have are just like his washing machine breaks and he gets a bit of a flood over the floor and it's a £20,000 loss. So that's mostly what happens, and that's all fine. This just fits in this little circle here where whenever someone gets a loss, these little claims go back to pay, and we know that it's the premium of the many paying for the losses of the few. So the fact is Jonathan has also bought insurance, but he doesn't have his washing machine break that year, so there's enough money in the system to keep paying all these little losses. But insurers also know that they may have a catastrophic loss, and when they have a catastrophic loss, they need to buy a big product to cover them for many of the houses going at once. So a catastrophic loss is like the floods that you've probably seen here this year already, like what we saw in California. That's a catastrophic loss. That's many properties going at once, and they buy what is called reinsurance, which is just a big insurance policy to cover major losses, and that's the global reinsurance market, and it operates just like insurance. So the premiums of the many insurers around the world pay for the losses in just a few countries around the world. So that actually most of the time has worked pretty well. So why has it stopped working in an industry that's been going for at least 200 years, maybe more than that, depending how you calculate what the start of the insurance sector is? Why is this thing that worked so well no longer working? I'm going to take you through three things. So first is risk-reflective pricing. So we have got better and better at analysis and models and things like that. And following Hurricane Andrew, which was a surprise and shock loss to the insurance sector in the early 1990s, where they had much bigger losses than they thought, they started to harness the capacity of these computing models to calculate the risk better and to charge more appropriately. So in the old days, you just know that you've got this many people to insure, and it's a bit of a crude thing, but you want to cover them so that you can cover this much probable maximum loss, and you divide it up, right? And you do some basic probabilities. But now we can do these very sophisticated Monte Carlo modeling to understand who is most at risk. So that's good, actually. And then you apply the global financial crisis and the need for regulators to say, well, we can't afford to have collapse. We need to require all these finance sectors to prove that they will be solvent after a disaster. And that makes good sense to me because, quite frankly, if I'm paying you my insurance, I would like you to be solvent so that at the end I get some money to make me good. So then they start asking for greater solvency, and they started asking for more prudent risk-taking. This means you get risk-reflective pricing, which is good if you think about what's fair. So if Konstantinos lives by the river and he floods a lot, he is higher risk. So the way risk-reflective pricing means his payments should reflect his risk. So that's fair, right? He's bringing more losses to the collective. He should pay more. The problem with that is if Konstantinos lives next to the river and the prices go up, it's not just that he pays more, he stops paying because he can't afford it. So we're going to talk a little bit about that. But as more and more people start to fall into that group of people, because it's not just one or two Konstantinoses, because climate change and a range of climate change and increasing urbanisation, alongside legacy assets, we've changed the way that water flows, we've increased the likelihood that water will be more catastrophic and those kinds of things. We realise all of a sudden that swathes of our population, as I said, 15% of Australian households are facing 4 weeks or more of pre-tax income, then more and more people face risk-reflexive pricing that means they are no longer insured, point one. Point two, these widespread losses are also happening. Insurance is a bet against the future. So it is to make you good with what you already have at a future moment in time. So it's calculating an inflationary marker in which it has to make you good. So with widespread losses, every time you have a widespread loss, you know, economics is not a waste of time because it tells you something about supply and demand. Every time you have a widespread loss, you will then have a mass demand on materials to rebuild, a mass demand on tradespeople to do rebuilding, and all of that will suddenly become a very inflationary market. And that is, so what you see is it costs more to rebuild after a catastrophe. So increasingly they're charging more for the catastrophic losses they face in the future so they can make good on their promise. And at the same time, they're paying many more losses and the reinsurance market is paying many more losses. So the global reinsurance market is paying for California wildfires, it's paying for floods in Europe, it's paying for maybe not so many fires in Greece because less and less people, you know, insured. It's paying for floods, and right now there's a cyclone threatening my hometown in Australia, so it'll be paying for that pretty soon. So it is paying for losses around the world, and that's just called the cost of capital. Supply and demand, you want more of this capital to cover these losses, cost of capital goes up, so they are charging more. And so what you see is this kind of perfect storm, which would have put prices up anyway, and then you add to this climate-driven uncertainty. So because of this weather weirding, or what I've called weather whiplash, you know, for example, the fires in California this time are in the winter. So we know California has fires, but now it's having fires in the winter. So although you will not see a line in premium calculation that says, and then I add this much more on for climate change, the uncertainty increases the prices as well. So we put all these things together, we get the perfect storm. This is the empirical reason, right? This is my empirical reason why. And what you end up with is people who are uninsured. This means people who simply have no formal capacity whatsoever to pay for the disaster. So they aren't well enough off to be putting something away for a rainy day. What you also have some who style themselves as self-insured. And so they say, my insurance is now $30,000 or £30,000. That is too much to pay each year, but I will self-insure. I will put money aside. So they are the privileged people. We hope they're putting enough aside. We hope they're great risk modelers and able to calculate their risk. Because after the disaster, the only thing I absolutely know is that none of them will have global capital or any prearranged funds to come to pay. And so who do you think pays? The government, yeah, the government has to pay, and the government is actually not perhaps the most efficient at understanding how to pay for this. I mean, the insurance sector has at least learned how to do claims. And so on this, what we see is that funds, like government funds, other aid comes, you know, so humanitarian organisations, those kinds of things. And, you know, that is simply we the people. That is taxes being used to rebuild instead of taxes being used for education or you know, aged care or whatever else that you want your society to have. So there's no money tree. And so this is why I would like us to think about this is, whoa, one of these fundamental institutions that we think will continue to work for us is breaking down under this set of conditions. So what can we do about it? And I'm trying to say to you that this is not something that's just, you know, like some little thing happening here and there. 50% of people in Louisiana who want to get a home insurance policy simply can't. Believe me, that will be getting worse in the current situation, not better under the political situation. 15% of Australian homes in 2024, but I want to tell you that because it was 10% of Australian homes in 2022. It was 12% of Australian homes in 2023. It was 15% of Australian homes in 2024. So I'm waiting for them to do their August update in 2025 to see, you know, this is starting to get exponential. Pretty soon, most people will not be insured rather than the other way around. So what happens, what can we learn about this? And what we did is we studied these particular things we call protection gap entities. They are government legislated, so all of them are government legislated. They cannot come about. They're interventions in a market, so they can only come about by government legislation. And they are not-for-profit insurers or reinsurers. They operate in slightly different ways, but they have been brought in to counteract unaffordable and unavailable insurance. Pretty much none of them came about as a response to climate change and the situations we're in, but I want to show you what we can learn from them because of the ways that they did come about. Because their role is growing globally as disasters get harder to insure. So governments are starting to turn to them to try and make these things, to try and work out what to do. So what do they actually do? So the first thing is you can have an insurer one, which is like the one that I spoke about in New Zealand. So basically they act as an insurer for a certain amount of the disaster. And so, you know, like in California, like in New Zealand, you get that. So you buy your insurance policy and it covers you for all the normal things like, you know, your house, someone falling over in your house, some liability, a theft. But the disaster component, a little piece of that is sliced off and it goes to the PGE. You can also have a reinsurer. So we know that another part of the cost of premiums is, you know, the cost of capital. So you can have a government-based reinsurer. And that is actually what we have here in the UK. We have Pool Re for terrorism and we have Flood Re for flood. And they are reinsurers to manage the cost of capital to the insurers. Okay, so so these are the things that we studied for how they work, which I'll explain to you. But let me just explain to you a little bit about the data, because although this book has been written for a policy and practitioner audience, it's a really solid piece of work that is properly informed. We are not writing an airport management book, we're writing a scientific book. So the overall design is we studied 17 of these PGEs operating in 49 countries around the world, because some of them are multi-sovereign or multi-country ones. We took a multi-stakeholder approach also, although it is PG-centric, we started with the PGEs because they must be multi-stakeholder, right? They bring in private sector, public sector, they bring in different kinds of humanitarian organizations. So we studied them in, you know, in their full multi-stakeholder concept, way of thinking about it. And our data set is substantive. We interviewed 558 people. Some of them were multiple people in one interview, some of them were sequential. We did lots of observations at the field level. So from my perspective, it is a bit of a practice-based study, but it's a field level practice. And we obviously, there are thousands of documents, but we isolated to 962 to the main ones. And we did this over like a 5-year period from 2016 to 20. We're never quite sure where it's finished because you never really stop, right? But 2020, 2021, we stopped actively collecting data long enough to write a book about it, put it that way. So what I want to say to you is we were participants in this market. So we, you know, like I'm on the OECD board for the financial management of catastrophic risk. I believe Konstantinos is now on some flood resilience body here in the UK. We became participants in this market, speak at the conference and all that, and, you know, so impactful work. But I would like to say we were participants in another way. So this is just a set of photos. And let me show you this video.
Piece of pontoon with a whole boat on it that's been washed loose and is floating down.
So these are just a few pictures from the 4 countries that we come from, our author team, that of catastrophes that happened while we were gathering data for or writing this book. And that one, as the book was about to go to the publishers, I had not long moved to Australia. I had bought a property that was above the flood maps deliberately. And in February 2022, I watched over 3 days a year's worth of landfill wash past my house and into the sea, where it killed seagrasses and did all the things that damaged biodiversity. So, you know, what we're trying to say is all of this is from our own countries. You are a participant whether you choose to be or not, because your country will be participating in these disasters and therefore the fallout from them, just to give you a bit of a feel for that. So, you know, it made us active, it made us activistly concerned and quite keen to get this message out there. So I'm really grateful that you're letting me have a go at that. So we take a paradox approach. I now want to explain it to you theoretically. There isn't a watch in the clock in this room, and I just worry that I talk too much because I love this story so much. But anyway, so I just try and go a bit faster. So what is a PGE? Is a not-for-profit government insurer, government legislated insurer or reinsurer. It is therefore innately contradictory and therefore paradoxical, because to have it's a insurer or reinsurer, it's a market thing, which is government legislated, which is a state thing. And I want to show you how that set of contradictions plays out to create some of the tensions that they have to deal with, but also some of the ways that they're able to help us reinvent this market. So for those of you who don't know what a paradox is, it's a persistent contradiction between interdependent forces. If you're still not sure what that means, I'd like to sometimes think of it as like a marriage. Okay, so if you're married and you no longer get on because you're getting persistent contradictions, you can get divorced. And as long as you have no children, then that is not a paradox. But if you have children, then you will be interdependent and still have to deal with that. So you will have to learn to deal with paradox. And so if you think about it like that, it's persistence of contradictions, but you can't simply tear the two things apart, and therefore the contradiction goes away. They are systemic contradictions that must be lived with in order to manage this situation. Insurance as a global system is actually a system that's very good at managing paradox. It has done this for hundreds of years. It is now breaking down, and this is what we're going to show you why, because there are three paradoxical elements that I'm going to talk you through that we will show have got to such a stage that they cannot be brought back into balance, and we need a new system. So insurance sits at a sweet spot which over hundreds of years it's learned to manage very well. It's actually a really amazing system, actually. It's a shame it no longer works. So the first thing is balancing control, and this is a case for all markets, right? So who controls the market? The government normally, in the kinds of contexts we live in, is simply regulatory control of the market. So the industry controls the market, manages pricing, manages all those kind of things, and the government regulates to make sure that the industry in banking or in most other sectors doesn't, yield excess profits or act in an inappropriate way. So insurance is actually a societal protection. It's a social good. It's protection from disaster, outsourced to a market who sells that protection at a profit, and the government regulates to make sure that it does so prudently. So normally that's the balance of control to make that work. Then there's an issue of knowledge. So insurance is a knowledge-intensive industry. I talked to you about in 1992, the increase in computing information. So you've always got to have a certain amount of knowledge. You can't take risk prudently if you don't know how much loss you could be on the hook for. So right from when insurance initially started as these kind of mutuals and things, social groups getting together to insure each other, it's like, well, how much property do we all have? And so what do we need to have an ability to cover? So you need enough knowledge, because if you don't know what possible losses you've got and their magnitude, you can't insure, because it's a technical thing. You have to know how much money you need to get in to pay for the losses. So you can't have too little knowledge, but on the other hand, you can't have too much knowledge. So you think, oh, well, the more knowledge you get, the better, right? It's become a very knowledge-intensive industry. We have great computing power. We can understand an awful lot about disasters and how they're going to happen. But the problem is that if I know that Konstantinos is going to flood this year, and I know he flooded 3 years ago, or if he's going to most likely flood again in the next couple of years, I have too much certainty. He is no longer an insurable risk because you need a certain amount of randomness, yeah? He is just somebody who is going to cost more than he can put into the system. So you can see how if you know too much and, all this great data we have, you could say that this thing here, if we weren't at the moment controlling health insurance, then lots of us, we have loads of data about how healthy you are. We know what you eat. We know what you buy at the supermarket. We know how much you move. We know what kind of stuff you do. So if we really want to manage health insurance in such a way as to control, to keep only the healthiest people because they will cause the fewest losses, we could exclude you, right? So far we regulate to make sure that we don't exclude you, but something to think about, isn't it? The more you know, you would think that makes it better to insure, but the more you know, actually the more exclusionary it becomes. Weird one, huh? Didn't tend to think about that. And then there's balancing responsibility. So insurance is basically a collective responsibility mechanism for individuals. So individuals buy a premium, which we all know is not actually likely to cover the entire value of their house. Yeah, so you pay premium every year throughout your life. That really isn't like a savings product and you get enough savings in there to pay for your disaster. It's leveraged capital. So the idea being that the collective will make good. So it's always been that. It's a pooling mechanism at some level where all of us have insurance and only a few of us need a payment in any given year. And it's an implicit contract that when I buy insurance, I know that I hope I don't have a loss, but I'm sort of implicitly aware that some of it will going to making Jonathan good after a disaster if he has one. So that kind of thing. So it's about responsibility. So that's important. I'm happy to bear responsibility in the pool, the collective, for the losses of the few. But in doing so, I would also expect that the individuals bear some responsibility not to load up with extra loss. So, sorry, Konstantinos, you're just a pretty difficult guy generally at the moment. So let's say that Konstantinos has got theft insurance. So Konstantinos, when he goes out, he leaves his windows open, his door unlocked, because it really doesn't matter, right? So you come in and steal his computer, what does it matter? It's insured, we'll all pay. Then he's not bearing responsibility for the losses that he brings. And that's why there's lots of things in insurance like, what kind of locks do you have on your door, and do these kinds of things. They do that to try and make sure that individuals bear responsibility to the collective in return for the protection that they are given. So this is the insurance sweet spot, and it's actually worked really well for hundreds of years. But what we're going to show you now is that when one of these gets out of whack, then all of them go. And so when you can't keep, they were always able to do this kind of teetering insurance. But once it goes too far, then all of them fall apart. And the only way that you can then keep insurance, and we never set out to be predictive, we are qualitative scholars, but this is predictive. When you get to this stage, you will not be able to have a private sector market that covers people that are at high risk, and you will not be able to make it come back. You will have lots of rhetoric around that. You might have rhetoric about it for 20, 30 years, but somewhere you will actually have to create a PGE if it's insurance that you want as the outcome. So happy to say qualitative research can be predictive. Okay, so let me show you why this works. I'm going to just talk you through a bit of this because you may say, well, I don't actually understand why you're telling me that, Paula. So let me show you why this works. So let's talk about the paradox, just the knowledge paradox, which is, let's say that society has too little knowledge to make a market. Okay, so you need enough knowledge, we agreed. You need to know enough about a disaster and its probability in order to be able to insure it. So if you want to have protection and you don't have enough knowledge, and terrorism is an example of this, then you will have to have a PGE. So the UK was one of the first to have a terrorism market because after the bombing of the Baltic Exchange in, what year was it, 92? 92, you couldn't get terrorism insurance in the City of London. And yet, now that everybody knew that terrorism was going to blow things up and destroy buildings, you couldn't get credit because you didn't have insurance against the thing that might explode the building. So they brought in what is called pool re. But after 9/11, many countries, all of a sudden, 9/11 was, terrorism had largely been given away for free, except in the UK, in insurance, because, well, terrorism isn't really a big property damaging thing. But then after 9/11, that was compound losses. So it hit every line from workers' compensation through to the buildings. And it was a catastrophic loss that really terrified the industry. And they did not collapse, but after that, they just couldn't do it because you need, to be able to calculate the magnitude of the loss and the probability of the loss. Even if you could calculate the magnitude of the loss, which means you have to have quite a lot of knowledge about the ways terrorism might involve, can you calculate the probability that an event of that size will occur? So terrorism became largely uninsurable except without a PGE. So if you want to have a market for terrorism, and you do, imagine trying to rebuild New York after 9/11 with no insurance, ain't going to happen, then you have to have a PGE. And what that PGE will do is say, okay, we want to maintain this market we've got, and so what we need to do is we need to ignore the fact that we don't know enough about this risk, okay, which a market can't do, because it can't say, I don't know about the risk, but I'm going to take your money anyway, and let's go and hope we've got enough money. So then this is something the government has to legislate for. We will ignore too little knowledge, we will keep providing an insurance product, and if it all goes south, we're on the hook to try and make this thing work. Okay, so that's one way that you can do it, and we have this in both earthquake and in insurance around the world. let's have a look at the other thing. Okay, so what about when you want to make a market? You can actually use a PGE to make a market. And this is one of the most startling innovations that we have seen. Insurance and innovation probably aren't two words you put together very often. Have to say that's probably the case for me too. But this one is very innovative. So there's a lot of countries that, as I showed you, don't have much insurance. Simply because they don't have that kind of wealth in order to build that capacity. What if you want to start bringing insurance to these countries, because that will bring money in for disasters? And this is the multi-country ones that we looked at. So they developed a product that's called disaster liquidity insurance. It's really amazing. So most insurance is indemnity insurance, yeah? You expect that when your house is damaged, you are indemnified and they will build back your house. But when disasters strike in these low-income places, they actually need liquidity. If you have money immediately after a disaster, you can keep the generators going. You can clean the water. You can put up temporary shelter. And you need to do that in the first week after a disaster, because if you can't do that, then you start to get all the exacerbating things and the costs mount up. So this is a product called disaster liquidity insurance. It's just a product that if the wind blows at a certain level or the drought is at a certain level or something like that, then you'll get a cash payment immediately. It might be quite small. It might be $8 million US. But $8 million US arriving within the week of the disaster is really valuable money, and the international aid community cannot organise fast enough. So international development, international aid will not flow as fast as capital, because capital's kind of fungible. We love to hate markets, but if the money's in a special purpose vehicle and it triggers, there it is, because it was sitting there. So, you know, it can actually work, and they worked out how to do this. I think this is wonderful. But still, you need a model. You can't get people to put private sector capital on something if they don't have a model. And because these places had never been insured, they didn't have a model. So PGEs, which we watched these came up to make a market, and they developed new knowledge. So, for example, the one in the Caribbean, which is the longest running one, actually the Japanese donor arm funded the modelling of hurricanes so that we could build a product. The German and the British and some of the World Bank money went together to make the operating capital to build an insurance company, and then all the Caribbean countries could come in and use this vehicle that had been funded by donors in order to create these insurance products that would then make capital flow, because capital is also agnostic. Make me a product that I can, you know, fairly evaluate the risk on and make returns as appropriate to that risk, and I will bring you the capital. So developing new knowledge created a market, and we studied these, and I think that's what I presented when Bashak invited us. Konstantinos, I presented that. And there was like something like 78 payments over a 13-year period to around 20 countries. So it worked. You know, you can complain about them. They always look like they're going to fall apart, but actually they deliver quite a lot of money over time. So that's one thing that can happen. And in fact, if you start by ignoring too little knowledge and take the risk, you can also start to develop knowledge, and we do see that. So there's a lot of advantages in PGEs addressing the imbalance in knowledge that I hope I have convinced you the market can't address because it doesn't have the facilities to do so. What I'd like to talk to you now is the more worrying one from the perspective of sustainability, and where I hope the bright minds in this room are going to fix the problem, which is too much knowledge. We are now in a situation where we have too much knowledge of the likelihood that things are going to go bad and cost a lot. So this is called the risk reflexive pricing problem, which is we know more about risk, and we know that more and more properties are going to have excess losses. Therefore, and this is actually a quote from 2016, we chose this because it's a UK one. So you think about that, like 30 to 40,000 pounds for a 300,000 pound house. That's not insurance. That, you know, if you were economically rational as a homeowner, and many of us aren't about our homes, there is no way you could come up with an economic rationale to pay that. It's more than 10% of the value of your house every year just to insure it. So the truth is, and as people say, it's risk reflective, but it's not real world. It reflects the risk that this property brings to the portfolio, but who's going to pay that? So a clear indication that we have a social need to do something. So you see how this knowledge problem also creates that problem between who's responsible, the government or the market. Society needs protection. The market can't deal with it. Someone else is going to have to deal with it. So you see this relationship between the paradoxes. So if you want protection from frequent severe disaster and the insurance industry can no longer offer that prudently under risk-reflective pricing, you need one of these. Flood-re in the UK. We have a cyclone pool now in Australia. They have to ignore the fact that they have too much knowledge. They have to know that Konstantinos is going to flood regularly, and they still have to insure him in order that he can stay in the net while we work out what we're going to do about him, you know, or his property. And this is the kind that we see coming up more and more now. Governments are looking for some way to solve this problem, and how can they deal with it, and can they make a PGE? It is going to have some weaknesses, and I'm going to talk to you about those. But for now, Chapter 2 of our book just deals with this knowledge paradox. Then Chapter 3 shows you how it affects the control paradox, and Chapter 4 shows you how that then breaks down these individual and society contracts that we have, or individual and collective contracts that we have. But just to show you that, you know, we can walk you through this. Paradox theory is both important theoretically, but also important practically, to show you how and why a market doesn't work and what we do. But let me show you now the thing of what comes up. So when you get these new ones that have come up under this brave new world of increasing urbanisation and assets in places where extreme weather now causes greater and greater loss, including California, people say, well, why should we have a PGE? So flood-re in the UK, if you're insured in the UK, £10 worth of your insurance policy will go into a subsidised pool that will then make sure that people at higher risk can still get an affordable insurance policy. And you may say, well, that's not fair. You know, Konstantinos gets to live by the river. I live on a hill, so why am I paying for him? That's not fair. You know, he's the one bringing the risk, so he should pay. And that's what's called moral hazard, that some people are free riding on the others, knowing that they bring more risk to it and they're not paying for the burden that they bring. So why should we pay for them when they're doing all the costing? And that is one argument for fairness. I mean, it's not an unreasonable argument for fairness. Fairness can be judged in many ways. So what we need to understand, and this is one of the biggest criticisms of PGEs, and you will particularly hear this from the private sector whenever a government wants to set one up, which is, you know, the PGE will actually make risk worse in this country because the insurance sector is sending an important price signal that this is a bad place to live. And by putting the prices up, and if you get a PGE and it suppresses the prices, then people will continue to live here. So actually, it's a bad thing to have a PGE because it's taking away the incentive to adapt to or mitigate the effects of climate change. And that is also a very reasonable argument. I mean, here's the problem with the paradox, isn't it? That is not unreasonable. So you can see that there's a contradiction immediately emerges if you want to insure these people. I want to just ask you a little bit of a question about this issue, though, of moral hazard, because moral hazard makes assumptions that you knowingly take these risks without, in a profligate way, not caring for what happens to others because they will pick up the damage. Two stories I'd like to give you. So again, I'm going to be a bit parochial here, and I'm going to talk to you about my country. Well, my current country. England is my country too. After the 2017 floods, this particular area, it's called Townsville, it's up north, the aged care home there found that its premium increased to $670,000 per annum. So this is an aged care home. Yes, it's a profit-making business, but it's a regulated and capped profit-making business. So it's not able to put up its fees for aged care, and yet it also must be insured. It can't go without insurance because it's got old people in it. And so where do you think the money can come from? Like, you can do the maths. That's $8 a day for each of the 230 residents just now to cover the insurance costs. And since you can't put the price of the care up, there is only one place that that price can come from. We're going to have to give a little less care in order to give a little more money to insurance. So we could say to ourselves, well, why don't they just move? Because that's the price signal. There's a price signal, so why don't they just move? Well, I guess they don't move because they never set up to live there. They are now in a situation which they cannot resurrect for themselves, and there isn't somewhere else for them to go. So is it my mum and dad in the aged care home that are a moral hazard on society, bad people living in a bad place and they should just pay more? Or should we reevaluate the notion of moral hazard? Let's take something that's maybe a little less ambiguous, because of course aged people make it a little bit emotional, and I kind of did that on purpose. So here is Thad. Thad owns a steakhouse and lodge in Colorado. And after the wildfires, which did not in fact affect Thad's property, you know, it's a business, he runs a business, he should pay the costs of running a business. He has actually not been burnt down, but certainly a fire did get close enough that you could see the smoke. The next year, his premium went from $40,000 to $400,000. So, okay, Thad should probably not be there now, but how quickly can Thad dismantle that business and move that business? So I think the question that we might want to ask ourselves is there a problem of legacy assets, so things that were already there and were perfectly insurable, and then the weather got worse and the conditions got worse and all the things we built around made those conditions worse, and now something that was perfectly insurable and bought in good faith is no longer insurable? So the question I guess I have is, are these examples of free riding, which is what moral hazard is about and all that? It's not fair, and use a price signal to force them to move and to behave more responsibly. Is it actually a relevant question in the world that we now find ourselves? And that's a question I'd actually like to ask you, because we've got a paper on it which has got a conditional acceptance of the British Journal of Sociology on this question, which is, so who should pay? Because both arguments are fair. All right, so who should pay for the costs of disaster, the rising costs of disaster in an insurance-prone world? I have some strong views about it. I'm very happy to talk about them. But these are questions more that societies are going to have to get to grips with, or are trying to get to grips with now. So that's one thing. The next thing is, can we make it fair? So my question is, well, can we make it fair? Can we learn something from these PGEs? Because there's no doubt that if you just put in a PGE to bridge the financial gap, right? So you say, let's keep them all insured, but do nothing about the risk, you will actually make it worse. And that is indeed what has happened in America with the National Flood Insurance Program, where houses were rebuilt on floodplains over and over again. The exact same house, can't profit from disaster, but here's your insurance claim. Rebuild the same house you had where it's already been proven to be inadequate. So I get it, that is not a good thing to do. So can you do something else? And we want to show you a system that can do something else. So if you have compulsory insurance, and you have that in 4 of our cases, New Zealand, Switzerland, Spain and France, it is compulsory. Everyone has to take this in disaster insurance. And you may think, well, that's really unfair. But actually, it's two things. It's compulsory for you to take the insurance. It's also compulsory for the PGE to give you insurance. A private sector insurer can refuse you anytime they like. Your PGE cannot do so, so it has to take your risk. So it has to be able to pay your claim. So what you find in some of these societies, so in Switzerland, they kind of think it's probably 100%, although nobody wants to put that in figure on anything, because how do you know, there might be someone not. But, you know, we're looking 85 to 95% in Spain and in France. That's very high insurance penetration. That means pretty much your whole society is insured. So you know quite a lot about your society, because insurance is a knowledge mechanism. You get a lot of knowledge because every time that there is a claim, you get the claim and you have to pay it, so you know where places go. And, you know, where they have disasters. So the first thing you can do is say, well, I've got to pay the claim. Why don't I build back better? Okay, so instead of insurance, which is build back like for like, which is proven not to be adaptive, what about I build back better? And this is what we're seeing with Floodry in the UK. So the idea of Floodry is it will be here, subsidise for a period of time, and during that time, the houses that get damaged will be built back better. There's a bunch of measures to make them more flood resilient. So we can use claims money to build back better. You can ask Konstantinos more about that, because he's studying that. That's why he's on one of these boards now at the moment. I want to show you something that's bigger than that, because you would think build back better, okay, that makes good sense, and that's like a first thing, and I think it is a first thing and we should work on that. But you need more than that, because it's not just the houses, it's the houses in the neighbourhoods and all those other things and where we choose to build. I want to show you the Swiss system. The Swiss system actually has this is its logo, and its logo is about these three parts that it has. So the first thing we have is prevention. So we try to prevent losses by working out where we should build and building the houses in such a way that they will be more resilient to disaster. So prevention is one of our key missions. The next thing is intervention, which means when a disaster happens, the more quickly that you can intervene, the less that you will have damage and loss. So actually, there's 16 of these public sector insurers that take all the disaster risk. They are compulsory. And they all put money into a fund to train the fire service, which is the first responders there. Because if you get first responders coming in very, very quickly, they'll put in barricades and things, they'll make sure evacuations occur, and you'll get a lot fewer, less costly losses. So they see that as important, and that actually comes out of their insurance premiums. And then, and I love this, and then, well, for everything else, we have insurance. But like, it's not, we're an insurance company, our job is making money out of premiums. We're an insurance company, our job is preventing losses in the first place and intervening to make sure they don't get worse. It's a very different way to think about insurance, but why shouldn't we think about insurance that way? So then this all turns into, well, when therefore, if we're going to do prevention seriously, then every time that somebody wants to build, or every time that a planning permission comes in to build, well, we should have a look at it because we have to insure it, right? So if we have to insure it once it's built, we should have some say in whether it should even be built because we'll have to take the risk. So all of a sudden they become part of the knowledge system for where and how we build. So what we get is increased integration of disaster response to decay and loss. What we get is integration in designing infrastructure, like, okay, so, this road, this tends to flood, this bridge, or once something's happened, you can't get into this place because these roads don't allow you to get in. We need to intervene and change that. We need to have different construction standards because these types of building we've found to get more and more losses. Swiss system's been running for over 100 years. In its current form, it's been running since about the 1980s. It's really done a lot of learning with the data that it has on where and how we should build. And then every time that they have any kind of loss, that's one more data point. So then that knowledge gets integrated in the risk maps to help with better risk knowledge in society, and it gets integrated into land use planning. Seems such a good idea, doesn't it? Now, why does it happen? Well, insurance is part of the basic system that is used, and it's public sector knowledge that is used to manage disaster, and it is integrated because it is public sector knowledge into the government framework. Because who's responsible for disaster resilience? Who gets to choose where and how we build? Well, actually, the government legislates that, and gives the planning permissions. Yes, it's private sector developers who do the building, but they put in for planning permission and these things. So what you get is all this knowledge feeding into a joined-up government framework and supporting the underlying resilience ecosystem. And it just seems to be the way it is. Nobody there thinks that is terribly exceptional. Well, yeah, it is our job to bring all the stakeholders together and sort out integrated risk management. We're a government. And we have government insurers. So I think that, is so normalised in that context and yet so exceptional in many contexts. So can we learn from it? We can just go, well, that's Switzerland, they're rich and weird, aren't they? Or we can say, well, even if they are rich and weird, maybe they weren't always rich. And actually, when these things that came about, you know why they came about more than 100 years ago? Because back then they realised that the poor people in agricultural areas, particularly, or rural areas, after things like avalanches, were disproportionately badly affected and dependent on charity to make them good. And they thought, not being such a wealthy country at the time, that it was not good, that only charity was there for them because charity cannot be relied upon, and they should set up a system to make something more consistent and reliable. So perhaps the whole thing of once you choose a system of reliable societal protection, maybe it also allows the accrual of wealth and other forms of stability. One to discuss, I'm not an economist, I want to make too big a claim. So what we say from this is, okay, so if you have a PGE, instead of worrying about the moral hazard of a PGE, what about you just take it for granted that now we don't have quite the same thing. What we have is a moral opportunity. We can use this PGE for moral opportunity. So under normal systems, we do maladaptation, normal private sector insurance, or a PGE that is only there to mimic and replace just that little bit of the private sector will actually be a maladaptive system. So it will keep rebuilding local areas for short-term responses. And, you know, if you are the person who actually has lost your house, you will still find that a very good thing, because your house will be rebuilt and you will go back into it. And, you know, maybe you'll be there for 10 years before the next flood. Increasingly, maybe you'll be there for 3 years before the next flood, but still, you're there. But that, we say, is maladaptive. Let us use what we are learning to actually do climate adaptation, which is the things we see with the Swiss system. There is no silver bullet. Switzerland, France, this morning we were speaking with Spain before I came here, because they had those mass floods you saw earlier. You know, they are now doing an enormous amount of learning, because the truth is nobody gets off scot-free. There is no get out of jail on climate change. But at least they know something about it. At least they have a system, and they can now start to say, well, what could we do about this? And indeed, Switzerland has been for some time proactively trying to do something about this, including red zoning areas that will no longer be allowed to be sold. So I think one of the things that we might want to say is, since we already have a system that we assumes work, it's called insurance, and since we're actually doing quite a lot of managing around the edges with these PGEs to make it continue to work despite the fact that it can no longer work as a market system, could we use this as a source of climate adaptation? Could we learn? Could we make more of it? And that is another great question that I hope bright people here will solve. In the meantime, as I said, this book is about something that was not set up to solve the problem we are in. PGEs were set up to solve a whole bunch of localised problems in different countries about why people couldn't get insurance. But now they have learned a lot, and perhaps we can make more of them. I've talked you through the second chapter. Have a look at some of our other work and the other chapters, and then we finally try to reimagine the disaster insurance system and say, what would it look like if we simply embrace the fact that it isn't going to work as a private sector market purely anymore? So let's learn from these ad hoc solutions to make something more purposive than what we have so far, because then we could use an insurance as a tool that it initially came from, which is societal protection. And if you'd like a copy of the book, it's free. We're not selling anything. And since it is free, grab a copy of it there. And, you know, next time there's a disaster in your country, why don't you send it to some of your local MPs and say it doesn't have to be like this. We could do something better. We could do something different. So